In this video, we will see about calculating beta. Beta is one of the important concepts in finance because whenever we speak about expected return of a stock, estimating expected return or cost of equity, we speak about beta. This beta is nothing but sensitivity of a stock's price or stock's return to market's return. In other words, if I say beta of a stock is 1.2, then it indicates if market moves up by 1%, then the stock will move up by 1.2%. If market moves down by 1.2%, then the stock will lose 1.2%. In this video, we will see how to calculate beta. Here are the prices of stock, an Indian stock called Infosys. The daily closing price of Infosys for the last 1 year, starting from 11 June 2012 to 7th June 2013. And we have market. We use proxy, Nifty as a proxy. Nifty is the leading index in India. We have daily closing prices of Nifty for the same period. To calculate beta, we first need to calculate daily returns of stock and market respectively. The daily return can be calculated as today's closing price divided by previous day's closing price minus 1. You drag this, you will have daily return of stock for the entire period. The daily return of index is today's closing price divided by yesterday's closing price minus 1. So we have market's daily return. So we have calculated daily return of stock and market for last 1 year. Now we know that beta will be given by the formula covariance between stock and the market divided by the variance of the market. Let's calculate this. Covariance will be given by formula in Excel called covar, C-O-V-A-R. So select the two arrays. The first array will be the index return. You can even give it interchangeably. The second array will be the stocks return and click OK. We get 0.000044 as covariance. Now we have to calculate variance of the market, that is Nifty. Variance, we have two variance functions in Excel. One is VAR and another one is VARP. VAR assumes that the variance is being calculated for sample and VARP assumes that the variance is calculated for population. In this case, we are calculating variance for the population, so we'll use the function VARP, VARP. Select the daily returns of the market, that is Nifty, and click enter. Now beta will be given by covariance by variance. So the beta of Infosys is 0.64. There are two more ways to calculate beta in Excel. If you remember, beta is nothing but the slope of the capital market line, right? So, and capital market line is nothing but a straight line, and hence it will be given by the equation y equal to mx plus c. So let's use the function slope to find out slope of a straight line. Slope, and there are two arguments that are required, known y's and known x. Y's are nothing but the stock return, which is the output variable in a straight line, and x are nothing but the input variable, that is the market return. Enter and you will get the beta, which is 0.64 again. And the answer will be same. There are various ways of calculating it. There is one more way, which is called Linus function. Again, this is nothing but straight lines equation. So the known y's are the stock's return and known x or market return. You can leave the other arguments empty. So now you get 0.64 as the beta. So beta can be calculated in any of these three ways in Excel. However, please note that here we have calculated beta using daily returns. In practice, beta is generally calculated using weekly returns or monthly returns. So let's move ahead and calculate beta using weekly returns. So in this sheet, we have weekly closing prices of the stock and the index. Similarly, as we did in the previous exercise, let's find out the weekly return, that is this week's closing price divided by previous week's closing price minus 1. Similarly, this week's index closing level divided by last week's index closing level minus 1 gives the weekly return. Drag the formula, you will get weekly returns calculated for the entire 1 year. First, find covariance between the stock and the market. So select this array, the stock return, and then move ahead and select the second array, that is the market return. So we get covariance of 0.000135. Find the variance of the market. Use the function VARP and select the market returns. Now we get 0.000342. So covariance by variance gives beta, that is 0.39 when calculated using weekly prices. Now let's use the slope function. Slope, we have known x, that is the market returns. Known y's are stocks returns. So we have known y's, and known x are market returns. Enter, and we get the same beta. Similarly, we can use Linus function. Known y's, which are stock returns, known x, which are market return. Leave the other arguments empty. Enter, and you get 0.39 as beta. So this is how we need to calculate beta.